What did the Fed decide to do with interest rates? Are there big changes coming at the London Gold Exchange? The US debt hits $38 trillion. What does it mean? And why is gold taking a dip an opportunity for those that bought it at the top? I'm Steve Rand. This is Brian Keneally, and this is the Gold Spot. So Brian, as we film this, the Fed just decided to cut interest rates by a quarter point. What does that mean?
Well, I don't think it came as a surprise to anyone. Anybody that's been watching what's been happening was kind of ready for this. They were expecting a 25 basis point reduction. What it means is that any kind of a asset that bears interest is going to bear less interest, right? So it makes gold look more attractive as an investment. When you couple that with the idea that it's also weakening the labor market, these are things that are inflationary, which is supportive for gold going forward. The Fed came down on this kind of in a split way. They weren't all in agreement about what to do. And so that looks a little bit weak. But I think typically the drivers is going to drive the price higher. So overall, very bullish for gold. But then we had what happened at the London Bullion Exchange. Tell us about that.
Yeah, that's kind of big news. For years, there's been four major banks that have been involved in the London Gold Exchange. It's been JPMorgan, HSBC Bank, UBS, and ICBC. And now Morgan Stanley and Citigroup are getting involved in this, which might not mean a lot to most of our listeners if they just hear that. But what it really means is more competition is good. We know for a long time there's been a lot of maybe say control by some of these big banks to maybe keep that price contained to some degree. And the more players that are involved in that is going to make that more difficult as that is all spread out. So again, overall, this should be very, very good for gold in the long run. Well, there's no shortage of big stories this week. We see the US national debt now eclipse $38 trillion. It just doesn't stop growing.
Yeah, mark it down. October 22nd, $38 trillion. It was $37 trillion in August. Adding $1 trillion in just 2 months is kind of neck-breaking. This is the fastest accumulation of debt we've seen, Steve, since COVID. And it doesn't seem like it's going to slow down. In fact, their plan is to add $20 trillion of debt over the next 10 years. And we know this is all going to be extraordinarily supportive to the gold price going forward.
Yeah, it's crazy how much the debt is growing. We're now at 123% GDP. It's crazy. The U.S. has lost its the three major ratings services, Moody's, S&P, and Fitch. We've now lost our top rating in all. The direction things are going are unsustainable, and it's only a matter of time before things really start falling off a cliff. In fact, if you look at that GDP ratio at 200, that's where they figure is the place that basically the point of no return.
So as it relates to the gold market specifically, Steve, what does that mean for our investors?
Okay, so basically what we've seen is so far this year, we've seen about a 50% increase in the price of gold. And now that rally is we've locked in gains with a lot of traders and they're taking a bit of profit on this. Not so much the physical holders of gold that like customers like we have, or even the institutional banks around the world, the central banks of the big governments, or the bullion banks. In fact, it's paper traders that are taking in that price.
This week's action, gold has dipped 10%, but I mean, I look at that as a buying opportunity, really. And what does the one-year chart show us?
If you look at the one-year chart, that's where it's really going to become obvious. So if you go back to the one-year chart and you look at October of last year, you'll see that gold was trading at $27.87 per ounce before it dropped 8% down to $25.64. The next move was an up move going from $25.64, a 6% increase to $27.16. At that point, gold actually increased nearly 3 times what the drop was. Then in April of 2025, gold went from $31.35 and dropped 5% down to $29.83. But then we saw another big bounce where the price went from $29.83 to $34.24, a 15% increase following the last correction. Then gold corrected down 7% from April to May of 2025. And then we saw the last move that we had before the correction of gold trading from $31.77 in May of this year till $43.56 in October of this year. That was a 29% increase prior to just seeing the latest correction of 10% down to $39.75. So these corrections are all very much positive, and there's obviously part of a healthy bull market. What does that mean where gold's going to go? Well, the trend is certainly showing that it's an opportunity for those that thought they might have missed out on buying at the top and that the price of gold isn't favorable. Absolutely, this chart shows that it very much is. What this actually reminds me of is the 2008 financial crisis, where we saw gold move up from 2007 to 2008 by 53%. Then it corrected by 29% as, as investors had to cover a lot of their short positions. But then it was followed by a 165% move over the next 3 years. So remember, the long-term trend is very much intact. Investors, long-term investors at least, do not panic on 10% corrections. It's very much part of a healthy market.
So Steve, the bottom line for those that bought high are, don't panic. This is not a time to panic. You've invested for great reasons. It's insurance and it's going to be just fine. So you have to ask yourself, have any of these reasons changed? And if not, corrections are an outstanding buying opportunity.
So in a nutshell, gold is still trading around $4,000 an ounce. We're still up 42 to 50% year over year. Corrections are healthy after a 50% rally in the market. And remember that Wall Street banks are still targeting $4,900 to $6,000 over the next 1 to 2 years. So the takeaway, short-term volatility is normal. Long-term trend remains very much the same and very compelling. Physical gold offers all the things that we talk about. It offers no counterparty risk, no default risk, and a 5,000-year track record of real money in times of uncertainty. For those of you who bought at the top, take this opportunity to dollar cost average and strengthen your position. Click below for the Rookie Mistakes Guide, and we'll see you next time on the Gold Spot.
If you enjoyed today's Gold Spot, like or subscribe to both our YouTube and Rumble channels. Also, comment below if you have any questions or if you'd like to hear us talk about a specific topic in a future video.